Well, it's great to be back. Welcome to Beers with Rich. I'm Rich, editor of Under the Radar Report. This week, this little number got my eye for obvious reasons. 100% independent, family owned. I thought right up under the radar's alley. Wow. From Holgate Brewhouse in Victoria. Looks very Italian though, Amalfi Coast. Then our mining analyst Peter Chilton tells me it's a sour beer. Let's see what that means, because today I'm talking about his pet subject, contractors. It's cracking. Straight to Napoli, straight to the Amalfi Coast via Victoria. Well, it's a bit different. Could take a bit of getting used to that one. Yep. Okay, let's just get on with it. Because over the years we've done pretty well from contractors. And that might be sheer luck, because often making money in contractors is buying and selling at the right time. We got out of RCR Tomlinson, which blew up and made many multiples, i.e. before it blew up. But we've also been burned enough to realise that it's very much a case of buyer beware. So contractors and blow-ups are synonymous. I mean, look at this week's news of ProBuild. I mean, unbelievable. $5 billion of work in hand. Look at the ramifications of that. So the point about contractors is, okay, there is danger, but look at the profits you can make as well. Less well publicised, I might add. And not only that, but at Under the Radar, as I said, we have Peter Chilton, who was an ex-mining engineer. So we've really been benefiting from his insight. In the past year, we've doubled our money on GR Engineering, returned 30% on Southern Cross Electrical and SRG Global. On the other hand, we've been cutting our losses on BSA. So, look at the return on the S&P 200, ASX S&P 200 of 6%, and that's the yield on some of these stocks. So overall, we're big winners from contractors, but that doesn't make us oblivious to the risks. So I had a bit of a chat with Peter earlier today, and he was kind enough to give me a few tips about how to pick them. And the first one is quality. Here's to quality. The first element to quality is obvious. That's financial. Obviously, with these sort of companies, they need to have a strong balance sheet, otherwise they can't bid for business. I mean, if you can't be competitive, then you're going to accept all types of work, and work that's not economic, which puts you at big risk. So the first thing is strong balance sheet and cash flow. If you don't have those two elements, throw it out. The second relates to the first, and which is all the companies we look at. So, we look at these sort of criteria for all the companies, but it's certainly heightened with contractors, and that's customer base. So these customers of the contractors, they have to be growing. Growing customers means growing business. BSA, they're big customers of Foxtel, NBN, put the squeeze on them, and their business, margins sort of really got crunched. So that's where they struggled. On the other hand, some of these other ones I've talked about, SRG, GN Engineering, Southern Cross, they've been accessing that so-called future-facing commodities, nickel, copper, lithium, hydrogen and nuclear in the case of Worley, I think. But basically, having strong customers isn't enough. What you have to have is pricing power. And this is where your inflation beating sort of factors come into it. So basically, you have to have a product that's so important to these miners that they can't go elsewhere and get it, and you can increase your prices. Why is that so important? Because the results reporting season really highlighted for us just how costs are going up across the board for all companies, but especially in labor, especially in fuel costs. Like, these are sort of costs that can't be hedged, and these are the costs that are borne by contractors. But when they can pass them on and hold their margins, then they can really grow. They can really grow their earnings. So, like, basically, one example is GR Engineering. Well, they build and maintain processing plants. There's only so many companies that can do that. SXE, Southern Cross, they've got really strong electrical implementation skills on both sides of the country, and that is a highly technical industry that is rarely done at scale. So these companies have great IP. So when you're able to have this niche, that gives you a competitive edge. But we've covered quality. What else is there? Well, everyone knows that the return you get on any investment is directly related to what you pay for it. So not paying up is the key. But I guess with cyclical companies like these sort of contractors are, you have to be very careful. Like, PEs don't normally cut it. Like, just because it's got a low PE isn't a guarantee of value. What's more a guarantee, and similarly with dividend yield, if it's on a really high dividend yield, that could be a sign that it's under distress. So what you're looking at is cash flow. Cash flow, maintainable cash flow. So we like to use enterprise value to EBITDA. That's a proxy for operational earnings. So basically, that's your starting point, 5 or 6 times. But what's behind that, the E, is very important. And that's all about work in hand. Like, that's the lifeblood of these companies, the work in hand. And what type of work in hand as well. Like, you can't just, you've got to look at the length of the contracts. You've got to do a lot of due diligence on the makeup of their work in hand so that their assets and liabilities don't mismatch. That's what happens in cases like RCR Tomlinson, when their asset periods are short, the liabilities are long. When you get that mismatch, you can get into a lot of trouble. These companies can go down no matter how big they are. Speaking of size, let's have another swig of this Italian number straight from somewhere in Victoria. Let's talk about the big ones. Worley. This company's really been struggling for a while after its acquisition of Jacobs, like the giant company sold its US company sold its chemical business in a mega merger with Worley, and they've really been struggling to get their mojo. They probably bought a peak cycle, but now we've seen them really recovering, certainly the share price and also the earnings profile, which is much more diversified. So basically, although they've got like heaps of oil and gas work, which is their staple, they've diversified into everything that's forward-facing. Green energy, wind, solar, nuclear, hydrogen, you name it. They're trying to be in everything that's future-facing, and we still see solid value there. Downer EDI is an interesting one because lots of the companies that I've covered over the years have, made a move, to diversify out of mining. Rarely have they done as big a leap as Downer EDI. So this has had real growing pains getting out of mining, and they've gone into urban services, utilities, telephony, transport, building roads and trains. So it's doing lots of work for the government, which you would think limits the cyclicality of its earnings. But hey, we saw from the pandemic, even government shut down. So that's been a bit of a disappointment, but there's better value there. So where is the value in the sector is at the smaller end. Why do I say that? Obviously, being a small caps, specialist, I like the smaller end. What I like about the smaller end, what Peter likes about the smaller end, and he has a better idea than me, are that the operators in it are very experienced and entrepreneurial. These are people that have been in the industry for a long time. They have a big stake in the game, and they roll up their sleeves and get up and out of the office. So looking at the results, what's clear is that the winners are the ones who have been able to hold on to their workforce. And, they'll be the future winners too. Because, your labour force is everything. Now, that's okay for the big guys who can pay more. But for the smaller guys, it's more interesting. and you get a lot more leverage. Like for example, Maca, they increased their revenues 20 million. What did that lead to? A 3 or 4-fold increase in net profit after tax. That's the kind of operating leverage we're talking about at the smaller end of the contracting space. It's risky, but it gives you the kind of difference that you need to make for your portfolio returns. So what's next week? Well, we've got a lithium stock that's been on ice while the reporting season has been going on, so we're going to be releasing that. And we've got heaps of opportunities that are arising out of results season that we can't wait to give to you. So, and that's in both small caps and blue chips. So here's a toast to the contractors of the world who have stayed, who have survived and are now thriving. And, here's to Beers with Rich. Here's to me. See you next week.